So it's a great honor to have with us Marcos Buscaglia, who just published a book that we're going to be discussing. Um, Marcos is a graduate from UPenn, where he got his PhD in economics, has worked for many years in Wall Street, in Citibank and in Bank of America, now has his own uh, analytical firm of Latin American economics and politics, and has been in this business for quite some time. He's from Argentina. I'm from Venezuela. We both have been concerned about democracy in our home countries and worried about the role that Wall Street has in enabling or would-be dictators or actual dictators. And so, and that issue is what his book is about. So it's really an honor to have that issue discussed, because it's an issue that I have cared for some time, and it's really useful to see a treatment of it and come up with some solutions, and understanding what's sort of like the structure of incentives in the industry that may or may not help or hinder democracy and finance. So we have Javier Murcio with us, who's also going to provide some comments on Marcos's book. Javier comes from Wall Street, where he has been a portfolio manager of emerging markets fixed income for Standish Bank in Bank of New York Mellon, and he has been working with several of the major players in the industry, like Paribas and Credit Suisse. So without any further ado, I think, Marcos, we're going to sit to see your presentation more comfortably over here. You want to come, Javier?
Okay, thank you very much, Ricardo, for organizing this, and everyone for showing up. It's my pleasure to be here. So I will make a presentation of, taking some minutes, and then we can, we can take questions and discuss. So let me start by telling you how this started, because it's not usual for an economist to write about democracy, of course. And so it started with a conversation with a client in New York about the end of 2019, when Cristina Kirchner was about to become, vice president in this time, but of a ticket that she had chosen. So she would be. We all knew that she would be the president for the third time. And I had this conversation with this very smart, pleasant client, and he says, well, if the government of Alberto Fernandez and Cristina Kirchner do the right things in economic terms, like Wall Street always likes tight fiscal policy, tight monetary policy, hawkish, policymakers, we're, the market is going to finance them. And I came out and I said, this is not right. This shouldn't be right, because I knew for a fact that Cristina Kirchner would try to undermine democracy in Argentina, as she did in the previous two terms, at least by undermining the judiciary to get free from jail card. Why? Because she has so many corruption cases, big corruption cases, the biggest in Argentina's history. And let me tell you that the bar is really, really high. So I wrote an article out of this idea. I wrote an article published in the Financial Times blog Beyond BRICS, and I got a lot of attention. I got people journalists from Belarus saying, well, for instance, one example, we are being jailed, and at the same time, London investment houses are buying the bonds issued by, the Belarus dictator, where there's no doubt that he's a dictator, right? So that started the idea, and I started, digging, and what it emerges is that it's not only that I was concerned about Argentina or Ricardo about Venezuela. The world was immersed in a democratic recession. In the 70s and then in the 80s, there was a consolidation of the opposite trend. Democracy flourished in Eastern Europe, first in Spain and Portugal. Then, it went to Latin America, then Eastern Europe when the wall, came down. So there was a democratic, flourishing, but that came to a halt about the year 2006. And from then on, what started to emerge is that many countries, the democracy in many countries started to suffer. And as Harvard's Professor Levitsky says, democracy started to suffer not in the old-fashioned ways, not through coup d'etats, but basically through tinkering with the checks and balances, in the countries, like tinkering with the independence of the judiciary, the independence of the press, et cetera, et cetera. So, these democratic recessions came down relatively slowly in most countries. And this has been registered, and I will talk about a lot Freedom House and other, houses that measure democracy. This has been registered in real time by democracy watchers like Freedom House and Economist Intelligence Unit, VDEM, and many others that measure democracy. So you see, basically, I mean, these are rankings of, the higher, the more democratic the country is. Basically, these houses measure, the sanctity of the electoral process, the independence of the press, of the judiciary, different measures, like several variables. And there's a lot of discussion about this, but then I will talk, more about how they are useful, useful measures. And basically, you see that democracy started to recede, particularly in the emerging markets, right? The Economist Intelligence Unit, the same trend you see here. So basically, there is a democratic recession, and what is important to note is that at the same time, portfolio flows to emerging markets countries, soared, increased significantly. It's not only that foreign direct investment increased to emerging market countries at this time, I'm talking about the year 2006, as you can see there, but also that if you look at you have to look at the red part of the bars, right? These are the flows. Portfolio flows started to increase significantly. Portfolio meaning, people here in Boston or in New York buying for pension funds in the US or Canada or Europe, buying bonds issued by the governments of these countries, or stocks of companies that are headquartered in these countries. Portfolio flows, if you look at the red bars, by the year 2006, they started to increase significantly. Then they came down up, particularly pertaining to what happened to monetary policy in the US mostly. But at the end of the day, at the same time that democracy was starting to be under attack, Western investors started to invest more in these countries. So I started to look at several countries, and that's what I do in the book. In the book, I selected some stories: Venezuela, Turkey, Russia, China, Hungary, and then a little bit of Belarus and Poland, and also a subset of Latin American countries like Argentina, Bolivia, Ecuador. So basically, trying to put together what was going on in the market and what was going on with democracy. And what you find is really startling, because you see that democracy was being dismantled, and at the same time, markets were totally oblivious to that event. Let me start with Venezuela, and I see there is a typo here. This was not a presidential election, by the way. You will notice this, Ricardo, very, very fast. But basically, let me tell you what happened. Chavez came to power in February 1999. Day one, he called for a referendum to change the constitution. Let me note, there was not the mechanism to change the constitution. There was the old constitution didn't have a referendum as a mechanism to change the constitution, so that was unconstitutional by itself. The Supreme Court said nothing, so basically he changed the constitution, where he got most of the votes in the assembly discussing the new constitution, and he got rid of all the checks and balances. He packed the court. After a few years, he changed, the term. He eliminated term limits. But the basic obliteration of democracy in Venezuela was done at the beginning of 1991. So February, right? June was the constitutional election, for the Constitutional Assembly. In July, Chavez comes to Wall Street. He rings the bell in the New York Stock Exchange. He basically went to, the Waldorf Astoria, gave a speech to the applause of all the investors. And they don't only cheer him up. Venezuela started to issue bonds in 2001 and 2003 when few emerging markets, issued bonds by then. It was a very limited market. Why did markets love Venezuela? Because oil prices started to go up. So Venezuela and PDVSA issued, a big amount of bonds, billions and billions of bonds. The government, 43 billion bonds, and PDVSA, another 34. PDVSA is the oil company, the government oil company, 34 billion worth in bonds, which ended up by different mechanisms in the portfolios of Wall Street investors. And the market didn't care. The market only started to care about Venezuela about 2014 when oil prices came down, right? But not as much. Come 2017, there was outrage in the market. GSAM bought 2.8 billion worth of bonds, in May 2017. The outrage was because a few days before, a famous economist called Ricardo Hausmann published an op-ed calling them hunger bonds, basically saying whoever buys these bonds is subjecting the Venezuelan population, correct me, Ricardo, to starving, because the government is willing to starve the Venezuelan population if that needs to happen to repay these bonds, right? And in spite of that, this company with well-intentioned people, bought this bond. And I will elaborate on why they bought that, and why the market continues to buy these bonds. So basically, the point is here, you see that democracy in Venezuela, deteriorated. By 2016. Freedom House degraded Venezuela to a not free country. It was already degraded to partially free in 1999, right? Well ahead of time. Economist Intelligence Unit degraded Venezuela to authoritarian regime in 2017. And in spite of that, the market continued to finance Venezuela up until what happened? The US imposed sanctions in 2017, and then bonds collapsed, bond prices collapsed, and then they could not buy bonds anymore. And that's one lesson that is important, that it's a big discussion, and we were discussing this with Ricardo before. That is, there is not I will show you later, but there's not a definite conclusion about whether investing in democracies is better than investing in non-democracies. But you see, as you go into the stories, you find so many examples of people that invested a lot in autocracies and they lost their shares. So these guys, GSAM bought the Venezuelan bonds at 30 cents to the dollar, very cheap. But a few months after, they were 5 cents to the dollar. Right? So they lost their share. So that's the case of Venezuela. Let me, I will just go over, then you can distribute the slides, of course. Let me tell you the case of Turkey is a very nice story. It's another type of populism. The populism in Venezuela is a populism of us against the elites, against Wall Street, against the IMF, against Ricardo Hausmann. Maduro talks about Ricardo, against Ricardo, In the case of Turkey, is a populism based more on the formation of religion, I would say, right? But the fact is that also Turkey has been, Erdoğan has been attacking the judiciary, the free press, the bureaucracy. All the checks and balances in Turkey had been demolished as time went by, and these were recorded in real time by Freedom House, Economist Intelligence Unit. I mean, it's not that nobody knew. They were being registered and spread out the word that these countries were, the democracy was basically in danger in all these countries. But the market, like Turkish bonds or Turkish stocks, not because, not because of what was happening on the democracy, but what was happening with the fiscal deficit or, exports. So basically, let me tell you one nice story about the one that I like the most about Turkey. so not to bore you, is that there were elections in last year in May, and all the polls pointed to Erdogan losing that election, right? He already had eliminated term limits, but all the polls indicated that he would lose because the opposition was united. What happened, like all the populists, to win the election, he was not only twisting electoral rules, but he was spending like crazy, like giving the gas for free for households and giving handouts, spending money, government money, like crazy. Well, it happened that 41 days before the election, markets cheered the fact that Turkey, the Turkish government, issued the first green bond of Turkey. Green bonds are very important now. There are trillions of dollars of green bonds and are very good. Green bonds are very good. But if you look at who issues the green bonds, oftentimes more than 1/3 of them are issued by non-democratic countries. That's the case of Turkey. The government got $2.5 billion in bonds 41 days before the election. Money is fungible. How come you know that money wasn't directed for Erdogan to win the election, which he actually won, right? Let me go to Russia. Russia is the same story. I will make it short. Basically Putin demolished democracy from day one. I mean, in the 4th day after he acceded to power in 1999, the police raided the offices of Mediamos, the biggest independent, broadcaster, and put the owner in jail a few weeks after. And in very different ways, Putin has been undermining democracy. And basically, Freedom House already in 2004 labeled it as not free, right? So this was recorded in real time by democracy watchers. But the market was basically still, like in Venezuela, Russia, for the same reason as Venezuela, it produced oil and oil prices were up. So, for instance, when Putin wanted to rip off the assets from Khodorkovsky, the owner of Yukos, right? Western banks offered the financing to Russia's government to basically rip off his assets in a very illegal way. The guy was jailed with no reason and stayed for 10 years in prison. And basically, the banks financing that operation were Western banks. But let me tell you, and the Russian story provides us with another, tale about the importance of, avoiding greenwashing. And this is the following. Basically, most investors in Wall Street track what is called bond and equity indices. So if you hire Javier, your company, your pension fund wanted Javier Murcio's standish to manage your money. Typically, companies like the one Javier Murcio worked in said, well, I will track the JP Morgan's emerging market bond index that has a number of countries with different weights for each country. And I will show you that I can outperform the index. I'm better than my competitor here, next door in managing your money because I will make better than the index. But your benchmark, the index that you're measured again is an index of bonds compiled by JP Morgan, or other banks. And in the equity business is the same. The Morgan Stanley stock index is the most tracked one. Well, it happens that a few years ago, JP Morgan, that has this called JP Morgan MB Diversified Bond Index, the most tracked by the industry, launched a similar one, but ESG corrected. Everyone knows what ESG is. ESG is basically acronym for environmental, social, and governance indicators that basically emerged as a response of market pressure for companies and governments to take account the environment, gender equity in the boards, and care for labor rights. So a whole industry appeared to basically take into account those demands. So JP Morgan launched the MB ESG corrected. Well, fun, quote unquote, fact. By the time Russia invaded Ukraine, if you were an investor tracking the ESG corrected version of the MB, you should have had a bigger share of Russian bonds than the non-ESG corrected. Is this clear? You know, so basically, my point here, what is in, I already told you that in the case of Turkey, you could see that green bonds can be greenwashing. And what I'm telling you now is that ESG, which is although very controversial, I think it's a very good development to, you know, again, take care about investor concerns, you know, that's not correct for democracy. In fact, in the case of Russia, you would have had more bonds of Russia by the time Russia invaded Ukraine than if you were not tracking the ESG corrected version of the MB. Okay, so let me skip China, then we can talk a lot about China. But what is the connection between Wall Street and autocrats? Is that Wall Street and the City of London have financed the governments of countries such as Venezuela, Russia, when they were turning more autocratic. This still goes on. Oftentimes, investors don't even know that they're doing that. You know, when I tell my friends, you know, that I can bet you that if you go now and check your portfolio, you are financing, you're financing a lot of autocracies, and you don't even know why. Because you put your money in some professional investment manager, right, like JP Morgan or Standish, and they track these indices, or you buy ETF, you know, and I will tell you what an ETF, and you yourself buy an ETF that includes those countries or stocks of companies headquartered in those countries. An ETF is basically a way to buy portfolios of securities. Like they track different indices. You can buy the most popular ETF, for instance, is one that tracks the S&P 500. Have you heard what is that? It's a composite of the 500 biggest stocks in the US market. So you don't need to go and buy each of the stocks. You just buy this ETF with a click of your mouse, and the company, let's say Vanguard or BlackRock, they replicate that for you. Okay, so there are ETFs of all the colors and tastes, including a lot of ETFs that track emerging market bonds and emerging market stocks. So when you buy an ETF, for instance, of emerging market stocks, they have 30% typically invested in China. Okay, so this is what happens. And again, the main market mechanisms are that equity and bond benchmark indices constructed by banks such as JP Morgan and Morgan Stanley, hundreds of billions of dollars invested in ETF and mutual funds use these indices as benchmark, and they're not correct for democracy. For instance, JP Morgan MB Diversified, not the one corrected by ESG, the most widely followed one, right, includes 35 countries. Out of 77 countries, 35 are non-democratic, and 16 are highly autocratic, in a way that I will define in a minute. I will define what non-democratic and what highly autocratic mean. So my proposal is that we can mimic what investors have done with environment, with gender equity and labor rights in the last few years, incorporating them into the decision process in your investment through ESG integration, to do the same with democracy. Now, ESG is mainstream. $1 out of $2 professionally assets of professional managers manage in Europe. 1 out of 2 follow some ESG criteria, and 1 out of 3 in the US. So this is mainstream already. So we can do the same with democracy, in my opinion. But first, and with this I'm about to finish, you need to be sure that you're measuring this right. And of course, this is an issue of debate, right? You need to be sure that when you're saying, oh, this country is not democratic, that this is real. And basically, what we found doing research on this is that we took the 3 most common, democracy watchers: Economist Intelligence Unit, Freedom House, and VDEM. VDEM stands for Varieties of Democracy. They have this, they construct these indices, and then they label the countries, in these 3 or 4 categories. What we found to our satisfaction is that the correlation between them is very high. Very, very high, close to 90%. It's very different. In the ESG world, there is a lot of controversy because companies that measure ESG score for companies, the correlation between them is very low. So if she was scoring Tesla, she would say Tesla is a very good ESG company, high score, and then Ricardo would say no, it has a very low ESG score. The correlation is well below 50% between ESG score providers. That doesn't happen with democracy index watchers, right? The correlation is very hard. They're tapping and the same underlying reality. So my proposal is to say, well, just to be sure, let's label as non-democratic countries that are labeled in the lowest two, buckets by two of these democracy watchers. What I'm doing there is mimicking some. I talk a lot about bond indices. There are some bond indices that only invest in countries that are labeled as investment grade by rating agencies like Standard & Poor's and Moody's and Fitch, right? So basically investment grade means that there's a very low probability of default. But to put them in these bond indices, you require that the country is labeled as investment grade by two of these companies. Well, I'm mimicking that. I'm saying, if two companies of these, institutions label a country as non-democratic, well, the country is non-democratic. And you can exclude it from your portfolio, or you can reduce the weight in your portfolio compared to the benchmark index, which can be the JP Morgan index. Or at least, to start with, you could exclude the highly autocratic one, which I define as being in the lowest, bucket for two of these investment democracy watchers. So you see the countries that appear, I just put some examples, not all the countries in the emerging world, that, in the lowest one, you would exclude the worst democracy offenders. Just to finish, a couple of things. There is this question about whether investing in democracies is not only good, but is profitable or not, right? And the answer, we were discussing this with Ricardo, is there's not a definite answer from academia. There's very little research on this, actually, The most comprehensive one that I found, this Leia Wineski, basically they do find that there is a positive relation between, in the stock market, they use stock market returns, the positive, result between democracy and investment returns. But to be honest, I don't want to oversell this. I don't want to come like some ESG providers come and say, buy ESG in the products, and you will not only do good, you will do better in your portfolio. And there has been a lot of scams about that. I don't want to oversell this, but what I do think is that has a lot more consensus, I think, although there's always some debate, of course, is that democracies at the end of the day tend to grow faster than non-democracies. So my take is that if that's really true, it should be the case, that companies that are headquartered in countries that are democratic end up doing better than in non-democratic countries. And for the same reason, governments that are in democratic countries, should be better payers over time than non-democratic countries. Finally, just as an example, I'm not selling products here, but it's basically, there are some ETF. This is a Liberty Fund, Democracy Investment. These are two ETFs, so you can buy them with your own account. And there are some institutional investors, Toba and Montomel, that are already implementing democracy-corrected investment strategies. All of them are in the equity world, not in the fixed income world, in the bond world. Well, with this, I finish. What I want to achieve with the book is first to raise awareness. The raise awareness is to let the world know that this is a problem, that markets have been financing autocrats, and this is not good, right? And there cannot be a solution to a problem that nobody sees as a problem. So I want to raise this issue, that this is a problem. And the second is to start proposing some alternatives. Of course, this is just the first step, but I think there are ways for you, if you want to avoid financing autocracies, there are ways in which you can implement that in your own portfolios. So with this, I end, and okay.
So very, very interesting. I have many questions to you, but before I raise them, let me ask Javier for his comments. Thank you.
Good afternoon. As you see, I dress the part. So no question where I came from.
Javier was, by the way, one of my most esteemed clients, you know, and he will work here in the Boston area. Yes.
Thank you. Thank you for inviting me. I mean, this is a very, very interesting, very topical issue. I took lots of notes before I came here, so I'm not going to go through them because I could get lost. I want to first present two things. One, the experience as a portfolio manager. Where does this present a challenge? How would one act around this very, very important issue? And the second, I will provide some ideas of my own, present them maybe questions to the panel about this whole challenge of the so-called democratic recession. Let me start with two numbers. Don't quote me exactly on them, but they're very, very close. 5% and 7%. The world, as you know, is experiencing a demographic wave. That means that there are older people, increasingly even in so-called emerging markets, and less working age population. Which means that anybody who has a pension or any form of retirement provided by governments, your own savings, etc., less and less working people have to work to give a decent return and hopefully a decent standard of living to the retired people. And the 5 and 7% number that I presented, and again, don't quote me on them exactly because these numbers tend to change depending on actuarial tables and so on. You need, at this point, a 5% real return. This is adjusted for inflation, or a 7% nominal return in nominal terms, you know, without adjustment for inflation. Of course, in the last couple of years, inflation has gone up in the world and so on. So that means that as a portfolio manager, and I was a portfolio manager at the institutional level, which means I was managing money not at the retail level, but for large pension funds, for large insurance companies worldwide, governments, and so on, I needed to at least get that, or not so much myself, because of course my part, emerging markets, was only part of a larger portfolio, but the clients would want at least that much on a more or less regular basis. And we measured that, as we heard, through measuring against indices. So the challenges were to beat these indices, and ideally to beat the competition. However, doing that is not always easy. Investing in emerging markets, you're dealing with basically an investor, two challenges, which I would argue are more increased in the emerging market world, which is the ability and the willingness to pay. And a lot of the rating agencies' views on these countries basically are based on that. How do the numbers look on a current basis and towards the future? And what is the environment, political, social, etc., where we believe that the government is going to want to pay? Now, something that Marcos presented here, the growth in assets under management in emerging markets or some of these economies, which took place in the 90s and part of the 2000s, coincided with a world where commodities were very important. There was a commodity cycle that defined the world economy. And as a client of mine back in the 80s, when I was working for a large consulting firm, told me, and I asked him, he was the CEO of one of the largest, perhaps the largest oil companies. I said, how do you deal investing in those countries? Are you afraid of guerrillas, civil war, working in a jungle, or all the challenges, you're taking oil out of deep sea and so on. And his answer, which I will always remember, was, there is no oil in Switzerland. You have to invest in Nigeria, you have to invest in Venezuela, you have to invest in Mexico, in Saudi Arabia, where oil is hard to get, etc. And I only present that as an example, because as it happens, a lot of emerging markets are very rich in commodities. So they enjoyed a period of growth, which coincided with what we call globalization and so on, which attracted a lot of capital. Because one of the things that capital goes after is growth. And these countries, as long as they grew faster than developed economies, they were a destination for investment. The other thing is that typically, if your investment is not going to give you a large return in developed economies, you go for riskier and riskier assets. That changed in the last couple of years. Why? Because money was free, as I call it, particularly after the crisis in 2008. Interest rates were zero, essentially, in the developed world. So during the previous periods, 90s, 2000, during most of my career, money was free. If you look at interest rates, were very low, which means that investors started moving more and more into riskier assets, and this involved emerging markets, because they offer you a higher rate of return. Lately, with us, as you know, interest rates have gone up in the developed world, et cetera, it has been a challenge for people that want to capture investment because you can get a 5% return in an investment in the United States, for example. However, as I said, getting there is not easy. You have to measure yourself against indices and so on. And let me give you an example of the challenge that you face. At some point, some of the indices that Marcos mentioned, the JP Morgan, MB or so, there are two indices that we want to get. Call it the MB and the MB diversified. Venezuela, who by then was already in the way of being non-democratic or autocratic, whatever you want to define it and so on, represented only, if I remember correctly, at some point, 3% of the index. So you say, as a portfolio manager, I can do without Venezuela, right? I have another 40 countries or whatever to invest in. However, the yield on Venezuelan bonds was 40% at any given time because of the risk of the country. The market was asking Venezuela to pay that much. So if you do the math, as a portfolio manager, you are punished by not investing in Venezuela because that little 3%, if you do the math, give me 40%. If I happen to be completely out of Venezuela, whatever I get everywhere else, 5, 6, 7, 8, 9%, does not compensate for me having been out of that little portion. Eventually, Venezuela was taken out of these indices, so on, which made life easier if you want. So what I want to share with you is precisely that. This is the challenge that an asset manager faces. ESG came a bit late in my career, and it's been very important and it's very encouraging as you see this. I read something that caught my attention that, for example, and I'm using ESG, of course, at this point as a proxy of what we're dealing with. Companies, that offer, management, they are getting into it not because they are being converted to the idea of ESG. They are getting into this because there is demand for it. And there are surveys that millennials, I don't know, and I don't know all the alphabet, millennials, ZW, whatever, I am ancient, so just put me in the old category, are becoming more and more aware of, in this case, of environment, if you want. And they are demanding investments in there. And companies are responding. So that is the positive side of it. Let me tell you, however, the negative side of it, not the negative, but perhaps a bit more pessimistic, and this is a discussion that we'd like to have, is a little bit out of what I should be talking about. But together with the so-called democratic recession or whatever we're going through, and some of the charts that Marcos presented and so on, I've been concerned, and this is not new, for years now, and I would probably argue this goes back 15 or 20 years at least. Surveys are showing that many of these countries are disenchanted with democracy. And here I want to present 2 or 3 cases, if I remember them all. And again, this is more of the discussion. This is a philosophical part of my presentation to you. I already told you the experience as a portfolio manager. Number 1, we will face a problem of gradation. Marcos has divided into autocratic or call it totally authoritarian, whatever. Think of Poland. 2016, Poland changes into a law and order party, which proceeds to do what these governments do, undermine the judiciary. And in the recent election, finally, this government is out. and we go back to democracy. What do you do in between? There are many ways, as you know better than I, how to define democracy, but lack of an independent judiciary is certainly not good. So do you help Poland in the process? Do you get out of Poland when the judiciary is certainly under attack and then go back when it is not? Another example, Mexico and El Salvador. Mexico, there is less, there is freedom of the press, but it's under attack. The president very openly, does what populist governments do, which is undermine institutions. However, his ratings approval, and I would call that clientelism, of course, because it's giving money literally to poorer people and so on, with all the discussion that this entails. He has 60% of approval. His candidate in this year's election is likely to win. He won majorities in Congress, majorities in the state governments, and so on. Is that democracy? El Salvador. There is an election coming up this Sunday. Bukele has, as you know, gone hard against narco trafficking and all of that, with all kinds of human rights abuses you can imagine. He's 90% popular in the polls. People want him, and goes back to what I mentioned a little while ago. There is a certain disenchantment with democracy. I've held the philosophical view that if we listed all the roles that you believe in the state, should the state be provider of health, of education, infrastructure, own companies? We can argue all of that, shades of left or right, whatever. At the very least, when people got together as a society in a cave, it's because you had a leader with a bigger stick that at least could defend you against the others or whatnot. And some people in these cases, as violence has increased in the world through different ways, seem to want that. So these cases worry me because not only there is indeed a democratic recession, but some people may do without it if it's going to provide them A, either means to living, give me the money, I don't care where it comes from, or B, deal with violence, which is hurting us all. And the final one that I want to make, and this is something that Marcos is more of an expert in, but believe me, Argentina was in the minds of everybody. 2019. President Macri at the time, of course, he did a lot of good things, if you want, that we would like to see. But we had a fear that Alberto Fernandez and Cristina Fernández de Kirchner were going to come to power. The IMF gave the largest single loan to Argentina. I'm sorry, in its history, to Argentina. 44 billion, if I remember correctly. Something that Argentina right now is struggling for the last couple of years and will continue to do so to pay. A few of us knew that that was the biggest mistake. For a number of reasons, there was no way that money was going to be paid. But the optics were very bad. In my mind, and I defend this view, it was an open way to say, we'll finance the candidate we want, Macri. He failed, he lost. It was money given away. That money went out immediately. Argentina has zero reserves at this point, negative in some measures. So, as an investor, where do you play all of this? Do you invest in Mexico, knowing there is an erosion of democracy? Do you get returns in a world that the commodity cycle seems to have come to an end? You still have the challenge of developing these 5-7%, whatever you want, in general, to finance the elder population in the world, or the aging population in the world. Is it something gradual? Can you move from index to index? You go from autocratic to democratic, back and forth. I'm thinking Poland, for example, in this case. So as you see, I think of it as a dynamic problem. So I want to stop here. I would obviously like to hear your comments and questions. But I want to throw some ideas, as I said, first to share with you what I believe is a challenge for my colleagues in the industry, asset managers. But also, if you want from a philosophical point of view, where or how do we get to this education and these indices and these indicators that an investor can feel comfortable in doing the right thing, which I hope people will do. Thank you.
Thank you. Thank you, Marcos. I don't know if you want to respond to that before we go on, but let me pose to you a question. And the question has to do with suppose we have the right measures of democracy and so on, and we strict access to the market of non-democracies and so on. What goals will we have achieved? One is we will feel better, where that we'll have some kind of moral kick because our money didn't go to fund unsavory people, or more optimistic, in description, is that you will make the life of dictators harder, and then consequently more likely that people in the country will want to kick them out, move them out. It will be harder for them to keep their coalition going because they're more restricted, or there will be payoffs to get rid of them because then you'll have more market access. So actually you are achieving some good in the world. So is it about you feeling better? Is it about a plausible theory of change where the world gets better? What underlying worldview do you espouse?
Yeah, no, it's a very good question, and so let me address that, and then address the issue of how gradual this is. That is also a very good question, and I think that, of course, the feel good is always there, like the same as buying a green bond or going into an ESG mandate for investment. Is the feel good part is always there, but I think that you can bring some change. Because at the end of the day, all these wannabe dictators that started not as most often they started as in a democratic elections. Take Putin, take Chavez. They were able to establish an autocracy because they were very successful in economic terms. They usually come when you study particularly the cases like Russia, Venezuela, even Argentina with the Kirchner. All these wannabe dictators come after a period of stagnation and depression, and people say, "Well, I want change. I want new parties, new ideas," and they come and they say, "I'm the new thing." But for different reasons, they're very successful. Chavez was very successful. The Kirchner were very successful. Putin was very successful. The Russian economy shrink every year, like 4 percentage points on average during the 90s. And then it started to grow like 7% on average during the first 2 terms. And so you say, well, so their popularity and hence their capacity to have majorities in Congress, which allow them to tinker with the judiciary and the press, come out of success. So my take is that part of that success was financed by the market. So if you took that money out, let's assume for the sake of the explanation that there was zero money, they would probably have been less successful and less capable of, bringing down the checks and balances by which they became dictators. I'm not sure about that, of course, but my take is that success, although they are dictators, they didn't become dictators in one day. There was a process, and in that, so if they didn't have that money from Wall Street, they would have probably been less successful, forced to adjust. Fiscal adjustments are very unpopular. Well, if they didn't have financing from the market, they would probably have had to implement fiscal adjustment, rendering them unpopular. And then people say, well, I want change. Before it was too late, because at some point it's too late. Look at Venezuela, at some point it becomes too late. So that's my take. So I'm not sure about that, of course, but my take is that success, these wannabe autocrats, when they see the process, they are able to undermine, year after year, democratic checks and balances because they're successful. They're like AMLO in Mexico or Bukele. They're very successful, and the market, I think, has something to do with that. And again, I'm not sure about that. It's the same debate as with sanctions. You're very well aware of that. I mean. Why do you impose sanctions? To make their life more difficult, or there is this debate, or to kick them out? Well, I think that at the very least is to make the life of them more difficult personally, even, But at some point you would like to introduce regime change, and I think the same about this issue. So that is to your question. And then what you mentioned about what do we do in Mexico? These cases that are not autocracies but are not democracies, and you look at these indices, they're starting to go down. The case of El Salvador to me is a little bit more clear because Bukele is running against the the Constitution has a term limit, which he's basically not obeying. So it's a clear-cut case. But it's a very reasonable question, Poland. What do you do? Because democracy, as I think there is a Larry Diamond, this democracy expert, says democracy is like a continuum variable. It's not one, because there are no coup d'etats now, or there are fewer. It's not 1 or 0. You are democratic or undemocratic. It's a continuous variable where one day one journalist is jailed, the next day one judge is kicked out without and so democracy starts winding down, like in a continuous. So at which point you say I will not invest, or so there are ways to address that. I think that is you don't need to have binary decisions in your investment as well, unless taking aside the obvious, biggest democracy offenders, right? But in countries that are, cases that you see a deterioration, but still, well, you can say I will not invest in Poland, but I will say let's assume that the JP Morgan MB index has 5% of Poland. Well, I will have 2.5%, whatever, like half of that. By doing that, you are also, I think, trying to get the same result, because if all the investors would do the same, the government of Poland, the party, what was the name? PIS, right? The PIS that was undermining democracy would have had less money, right? Or more expensive money if it wanted to tap the market, and basically it would have rendered them less popular and forced regime change even faster. By the way, Poland the Polish government was under the PIS that also, tinkered with the Supreme Court, the freedom of press, etc., was the biggest issuer of green bonds in the world, right? So basically, I think that there are ways to address your concern, which is a very valid concern. What do you do with countries like Mexico? It's not clear. The guy is undermining democracy, but it's still an electoral democracy. Well, I think that maybe avoiding binary strategy. In the same way that ESG, you have different ways to implement ESG. Some are called exclusion strategies. You don't invest in tobacco companies or oil companies, for example. But that's one type of ESG investment. Other type of ESG strategies is ESG inclusion. Well, ESG inclusion is, well, instead of having 10% of tobacco companies like my benchmark index says, I will have 5%. So in that way, I will be investing more money in companies that do good for the environment or for health. So there are ways to address that problem, which is a real concern, because again, democracy, I like this expression, it's like a continuous variable. It's like, there are events that are drawing you down, a democracy up or down, but oftentimes are very, small steps.
Right. Can I, sorry, couple of things. As you say, investing less or more is what we would call being over or underweight, or you can have zero. And I put the extreme case, like if you get out of Venezuela completely, say when it was part of the index, then you have zero. But instead of having 3%, you could have 1% or whatever, or you could put 5, 10%, whatever, overweight or underweight against the index. But again, only to repeat that there is a weight, there is a cost to that decision. Yes. Even underweighing Venezuela, say from 3 to 1%, if you do the math,
it's a lot.
You are punished.
Sorry, just to answer that, my proposal, of course, is that I hope all these index providers would offer what I call DSG indices. So they wouldn't pass the burden to you as an institutional investor, of being underweight. So like a new alternative, you have the JP Morgan diversified, and then you have the JP Morgan diversified corrected for ESG, and then you have a new product, a new index called MB diversified DSG corrected. And so in that one, you probably wouldn't have Venezuela, or you have a smaller share of Venezuela. So it wouldn't put a burden on you as an asset manager.
Let me give you some good news. I talked about before how sometimes it comes from demand. When you manage institutional money, as I said, large pension funds, governments, et cetera, you're pretty much dealing with only one institution or two. You know what I mean? Even it's not a customized product that anybody can go and buy, from a store. It's there were cases that we were asked, and mostly actually by Northern European
Yes.
governments or pension funds and so on, they would specifically ask not to invest, for example, in Venezuela. And that was good because it would be, I won't judge you against the index. I understand that you're going to underperform the index because you're going to be out of Venezuela. It's okay, So that is the good news. The one thing I've talked about dynamics, years ago, I came out with a term. It's not my copyright, but anyway, I tried to capture what was going on. I call it democratic populist dictatorships. What happens when after a while, and again, if you believe in populism as something that tends to undermine institutions, eventually they change institutions to the point that you are democratically elected because you change the electoral rules, because you change the judiciary, whatever. And it's like, hey, people elected me this way. You can argue, well, yes, because you don't allow opposition parties or something. But over time, that is something that seems to be happening in many places. And that is what worries me, that deterioration, that's what I call the dynamic, call it a trend if you want, will at some point represent a challenge. At what point, if you're moving in that direction, you are dealing with a democratically elected government that has changed the laws. And by the way, we fear about that in this country. In a way that, yeah, what can you tell me? I'm elected, the right way. So.
Yeah. Yes. Yeah.
No, we are out of time. So let me just see if there's a question from the audience.
Yes.
For us to.
I will answer them.
Yes. But in the back, yes.
Thank you. My name is Will. I'm an MPP1 here at the Kennedy School. And really fascinating discussion, and I appreciate it. I think my question is about, in response to your proposed solution, it seems like that there's a possible unintended consequence or risk of maybe strengthening anti-democratic coalitions. So it seems like there's this moment where, countries like Iran, Russia, China are coming together to propose alternate institutions to kind of the global system, right? So an example of that might be the SPFS instead of the SWIFT system. So I guess I wonder if would this type of index that you're proposing take developing countries maybe in sub-Saharan Africa or South America that are teetering on the edge and push them towards coalescing with anti-democratic coalitions?
Before you answer, let me see if there's any other question in the audience. Shreyas.
Thank you so much for the talk. I was wondering if you distinguished between bond markets and equity markets and how you think about penalizing sort of a nation versus penalizing governments. And this is, you said it's similar with the sanctions debate. And so I was wondering if you had more insight on that. Thank you.
Yeah, yes.
Let's go to you.
Okay, two very good questions, and just my I don't know if I have the answers, but yeah, it's a risk, right? You're saying, oh, I'm the government of El Salvador, and markets are not offering me money, so I'll go to get the money from Russia or from China, from wherever. That has already happened in some way. China is now the biggest official creditor in the world. The loans owed by developing countries to China are bigger than the ones owed to the World Bank, and the IMF. But that's a risk for sure. But I think that it's not a perfect substitute, in the sense that in as much as China has emerged, as a big creditor, the size of what it can offer, it pales compared to what the market can offer you, pales. And to be sure, the conditions asked by China are a lot more demanding, in terms of interest rate, maturity than
and collateral,
than what the market would ask you if you're well behaved. So my take, yeah, it is a risk, but I think that the carrot, of being a democratic country that gets funding from the market, it would be much would outweigh the cost, the stick. As to your question is, again, also a very good question. In the bond market, to me, is very clear. The government bond market, and the quasi-sovereign. If you buy a bond of PDVSA, you are financing the government of Chavez or Maduro, and then you may, or the case of Turkey that I wrote down. In the case of equity, it depends also. Let's take let's say quasi-sovereigns. The market, the biggest IPO by then in history was Saudi Aramco. This was in the working of investment banks, just at the same time as allegedly the royal family killed the Wall Street journalist Kamal Khashoggi in the consulate in Istanbul, right? Markets did not care. A few months up. So my take is that in the case of quasi-sovereign, equity, to me is very clear. Let's say with Gazprom. Gazprom was used, by Putin. Even I'm talking about before the invasion. You like to benefit when the Ukraine government was pro-Russia. Gas prices were lower than when the government was anti-Russia. So basically, by buying quasi-sovereign equity, you are ipso facto financing the government of the country. In the case of private companies, it's a more broad line, to be honest. There are a lot more gray areas, right? There is one case in which I think it's more clear-cut, the case of China. Why? Because when you read, the more you realize that all companies in China are supposedly, have CCP committee, Chinese Communist Party committees inside. They are forced to obey the government, to spy for the government. So when you buy Chinese stocks, you end up financing the Chinese government. There are other cases in which it's, not very clear, right? Because oftentimes companies in emerging markets are just trying to resist, the government. But let me tell you that the more you read, the more you realize that for them to resist, when you're buying companies in emerging market countries that are turning into dictators, the more to resist, they should bribe more officials. They should go into projects that the officials want. I mean, so in some way you are also financing the government. So my take is that, to be honest, particularly for the democracy worst offender, I wouldn't buy stocks of these countries.
Thank you very much. Thank you for attending.